In today's podcast, we're going to discuss what everybody is concerned about, but nobody wants to talk about or do anything about. It's risk management. Risk management is really important, but it is often viewed inappropriately by investors. I'm Don Creech, and if you have access to a video screen, we're going to have a lot of graphics today. Let's go back a few decades, actually, and take a look at Peter Lynch. Well, we're not going to look at him specifically, but we're going to discuss the fact that as the former portfolio manager of Fidelity Magellan Fund, which was the most successful fund in its day, long warned investors against what he calls diversification. That's diversification, which was basically cluttering a portfolio with too many investments. But once he established his track record and money flowed into the Magellan Fund, it became difficult for Peter Lynch to not be overly diversified. And of course, the phenomenal returns in his early years began to subside. Just recently, Jason Zweig, who writes regularly for the Wall Street Journal on the weekends, thinks many investors should be worrying about diversification. And that's the opposite of diversification. Rather than spreading your bets, you concentrate them, and that can be dangerous. Well, yes, it can be dangerous, but it can also be very successful. Take Warren Buffett. Warren Buffett's approach to diversification is that diversification is for people who don't know what they're doing. In his opinion, concentration is what generates returns, and his track record proves it. The problem is that the financial industry has bought into diversification primarily to provide protection against litigation when things go wrong. Because even Warren Buffett made mistakes. I think of Coca-Cola offhand. He bought Coca-Cola and thought he's getting a good buy because that's the only way he buys stuff. And it was years before that actually turned profitable for him. Making a good buy is a matter of perception. Risk is a matter of perception. I want to buy something that's going up, but I don't want it to go down. I don't want to lose money. That's the common mantra that investors accept and tout to their financial advisors. Tell me how to invest so I don't lose money. And so we end up with this asset allocation pie using large data history to say that correlations will be constant when we know correlations are not constant. Sometimes everything goes up together and sometimes they don't. We want to use the times they don't go up together as our justification for being diversified into assets that are underperforming and are actually a drag on the portfolio, instead of making a decision that Peter Lynch would have made, which is basically just sell the turkey. If it's not working, get it out of the portfolio and buy something that is, because wherever you look in whatever market, there is something that is always working. One of the things that we have seen is that this lack of diversification or diversification is actually sweeping through the exchange traded fund world. Investing in an ETF that tracks only a few stocks or even just one, or worse, one that uses borrowed money to expand its exposure, is a lot more exciting than holding an index fund that owns 500 stocks. And you have a concept that you can brag about if that's one that you own. But what it also does is ramp up your risk. If we go back to 1998, according to Daniel Soderoff, who's a senior analyst at Morningstar, 85% of stock index funds were weighted by capitalization. Basically, the companies that are worth the most get the biggest percent position in your portfolio. The biggest stocks have the heaviest representation. That's the way the S&P 500 works. Essentially, that's the way the NASDAQ works. The Dow doesn't. But when you're putting together an ETF or a mutual fund, You can pick your index and you decide how you're going to weight it. But by the end of 24, only 40% of the index funds were capitalization weighted. The median, or the typical index fund, held 503 stocks in 1998, but by May of 25, that had shrunk to 123 stocks. Basically, you got rid of 80% of your portfolio. Now, the more recently than an ETF is actually launched, there are fewer stocks in it. Newer investments are taking on more risk than most investors realize. Most investors buying an ETF that invests, say, specifically in NVIDIA, instead of buying the NVIDIA stock, the NVIDIA ETF may use leverage. People assume that they're buying NVIDIA, which they are, but they don't understand generally when asked about it that they're buying NVIDIA with a multiple factor of risk, downside exposure, which most investors don't want to accept. Here's our problem that we have as we take a look at the investments world and the history that we run through, the way markets actually work. When we take a look at the S&P 500, I'll get the right slide here in a minute. When we take a look at the S&P 500 and fund managers, the S&P is boilerplate, vanilla. Who wants to pay a manager for vanilla? And there's actually no reason to pay a manager for vanilla. You can go out and buy an S&P 500 fund. In days past, in mutual funds, the fees were pretty expensive, but in today's world of exchange traded funds, you can buy the S&P 500 for all next to nothing. The S&P 500 fund at Vanguard, I believe, is about 4, maybe 5 basis points. The broad market fund at Schwab is 3 basis points. What's that mean? That means it costs you $3 per year per $10,000 of investment. They're basically paying for the cost of a room for the computer, electricity, and air conditioning to keep the computers cool, because there's no manager, there's no staff. Everything is being done by computer because it's all math. There's no overhead expense, barely minimum. And Schwab, several years ago, as they really committed to develop their exchange traded fund arena, said they were going to be the low cost managers in the business. And every time some competitor raises their fee or cuts their fee to become more competitive, if they undercut Schwab, Schwab within weeks cuts their fees even more. This is a race to the bottom, which is wonderful news for you as an investor. But why are we looking at all these other funds that are coming out with higher risk? It's basically because fund managers are in the fee generation business. They're not there to make you money. They're there to raise revenue for themselves. And if they're going to do that, they must offer something different than an index of 500 funds that everybody knows what they are, and there's nothing new under the sun. So when we take a look at how these new funds are being created, they're being innovated with concepts. Maybe it's a single stock concept, but maybe it is a broader concept. One of which is recently, because of the development of data centers, is nuclear energy. So there's some nuclear energy funds that include more than a single company, but it is, if you want to be involved in nuclear energy in your portfolio, you can go buy it. And there is more risk exposure the more concentrated you get, but there's more fees involved for the asset management business. And that's where the growth in the fund opportunity lies. And it's attracting investors. So why not do that? The problem is that while these fund managers want to earn higher fees, they build these other funds that have more excitement for the investors than a traditional index fund. And they often take on bigger bets, which most investors are loath to accept but fail to understand. if investors fail to understand the basic math of investing, there's really no such thing as compounding except academically in the stock market. Because as this simple chart shows of the S&P 500 going back to 97, that the run up, the last 3 years of the run up in the tech bubble generated a double of your money from 97. It was up 106%. And then we get the tech bubble collapse and you're down 49%. Well, there's no compounding in that. And then from 03 bottom to the 07 top, before we got into the great financial collapse, which began in the summer of 07, the market's up 101. Well, if you're down 49, you need 100% just to get even. So from March of 24 to October of 07, you're flat. Absolutely no return. There is no compounding in the stock market. What there is protecting your capital and having a disciplined process and a discipline to make the decision and pull the trigger at market lows to recommit the capital. Capital accumulation, wealth management, and wealth generation in the stock market is not a buy and hold business unless you have a very long window of time. It is a manage the risk business. It's a process that demands somebody's attention. Even if we take a look at where we are recently, we end up with major disruption. And the Liberation Day announcement of tariffs by President Trump took the market down within a fraction of a percent of being classified as a bear market and upending the bull market that began back in October of 23. What's gone on in the meantime? A lot. The irony here is that many people worry about how concentrated the S&P 500 has become. And why has that happened? Well, the S&P committee basically looked at people becoming disinterested in investing in the S&P. And why are they there? They're there to attract money to be invested in the S&P because that's how the managers make money. So where was the money going? Well, the money was going to the NASDAQ where the tech companies were, which were a lot more exciting. They have new stuff that is attracting investors. It's attracting business people. It's attracting concepts of how the economy in the world is going to change. So what do the S&P do? Say, well, we don't own that stuff. We own the old stuff. So let's swap out some of the old and put in some of the new. And that's exactly what they did. So the S&P has become more concentrated. It's become more concentrated in technology as the primary drivers of the S&P returns. Bundling a limited number of stocks inside an ETF does not make them safe. Let's be clear about that. The fewer stocks you hold and the farther away from the overall market you move, the more extreme your returns are likely to become. The potential gains are greater, that's what you're after, but so are the losses. And you either have to maintain a sell discipline, paying attention and tracking your investments, or you have to have a commitment to hold through deep and perhaps protracted losses. Between 1985 and 2024, the average stock suffered a maximum interim decline of 81%. This is an ancient history, particularly for boomers and Gen Z. This is in their lifetime. The maximum interim decline of 81% was average. And more than half of those companies never regained their previous highs. That's according to research at Morgan Stanley. When we turn around and take a look at the S&P 500, and one of the things that technicians do, and we as chartists do, technical traders, is take a look at how the market is behaving overall. And the S&P 500 up at new highs is really interesting and is exciting, but it's being driven by basically the top 10 companies, and of those, basically the Magnificent Seven. What we look at, one of the things we look at is how much of the rest of the market is participating in this move upward. People are assuming that because the S&P 500 account is or index is up, that their account should be up, but they're diversified investors. I've rarely ever met a non-diversified investor in my entire career. There's a few, but you could count them all on one hand, and you could do so if you were missing a few fingers. And the current market, as of the beginning of July, the S&P setting new highs, but only 29% of the index components are participating in that. This is called breadth. It's a low breadth market. So if you own a broadly diversified portfolio, the odds are highly likely that you own a whole bunch of stuff that really isn't going anywhere. The only way your account is actually has a prayer of keeping up with the index is because you have concentrated the portfolio in technology. And of that, it must be AI related technology. Otherwise, you have too much diversification because you're trying to avoid risk in the market, generally because you don't really have any controls. And the standard investor today, relying on more modern portfolio theory with a portion of the money in bonds as the risk offset, has no way of keeping up with the market. Bonds, the AGG, which is Barclays Broad Bond Index, which includes treasuries and corporates, is in a 5-year bear market. It's 5 years of losing money in what is supposed to be your safety valve. That's diversification that is forced upon investors because of litigation, liability issues. They simply want to minimize that. And since the academics say this is how you control risk, as long as you have an 80 or 90-year window for it to work, you're fine. But you don't have that kind of window. You need to be doing something else. And one of those things is to look at what's actually generating returns in the market. Here's the PE of the top 10 and the remaining stocks in the S&P 500. We're told, because this is the way the financial community works, that the market is overvalued. The top 10 stocks in the S&P 500 have a current PE of almost 30, when the average is typically 20. When we look at the remaining stocks, it's 20, with an average of just under 16. Actually, the current was about 21 versus 16. So that's substantially overvalued from a traditional perspective. But what you want in your portfolio is performance. And in order to get there, you must have an overweighting of exposure to the Magnificent Seven, because that's what's generating the returns. In 21, the Magnificent Seven generated 40% of the return of the S&P 500. Through the first half of the year, the S&P is up 5%. And 6% of that, 3% of that 5 is generated by the Magnificent Seven stocks. I mean, that's 60% of the returns coming from concentration, which is exactly what Warren Buffett has done. When asked why doesn't anybody else do what you do? He says, well, because we don't operate by committee. Anything run by committee is going to underperform because everybody's scared to make a decision unless somebody else agrees with them. It's called the pass the buck or the duck routine. If something goes wrong, I want to be able to duck and point my finger to the other guy who's responsible for the decision or agreed to my proposal. So he was the checkpoint, and I just did what he authorized me to do. I just had an idea, and he said it was a good idea. So that's why we're underperforming. Well, that's why there's nobody else like Warren Buffett and Charlie Munger, because the committee can't do that. And if you want to improve returns in your account, you cannot do that by broad diversification. And you typically cannot do that except in rare market moments with a 60-40 portfolio. Well, if you're a regular listener to our podcast, you've heard this before. We believe in owning leaders. And when leaders quit leading, when they fall out of bed, we don't roll over and pick them up off the floor, wait for them to heal their bruises and climb back into the bed. They're on the floor. We're going to pick up a brush or a vacuum and we're going to sweep them off the floor, get them out of the way. And here's basically research that has been done by JP Morgan that validates the fact that leadership makes a difference in total return outcome in your portfolio. In the large cap blend area, the difference between owning leaders over a 20-year period of time versus laggards is 229%. If you look at large cap growth, which has been a dominant performer for the last few decades in the market today, the difference between owning leaders versus laggards is 560%. That's the reward to owning leadership. Even if you go to the bond market where people basically say, I don't want volatility, I don't want excitement, I just want steady returns. The same process benefits bond investors. The short-term bond performance between leaders and laggards is 43%. In the high yield area, it's nearly double. It's 86% differential between owning leadership and owning laggards. It pays to pay attention to what you have in your portfolio and not get married to owning any given stock. I think even of Microsoft, we go back to the tech bubble chart that I had a minute ago, I didn't point out Microsoft, but Microsoft went almost a decade and a half before it had returned to its 2000 peak price. That's owning. Even a good company has problems and is in the doldrums. Holding Microsoft for a decade and a half with zero return doesn't make any sense. There are a lot of other things that a portfolio could have capitalized on during the period between 2000 and 2007, instead of just simply holding something that was going nowhere. And even today, in a shorter time period since the Liberation Day and the announcement of the tariffs, the market has been extremely divided about where performance is occurring. Now, it's no surprise if you happen to be looking at the chart that's on the screen. The white line's the S&P 500. There's only two sectors that are outperforming the market just in the last 2.5 months. One is no surprise, that's technology, and the second one is industrials. Why industrials? Well, presumably because we're on the beginning end of an industrial revolution thanks to President Trump and the tariffs, which are causing industries around the world to come to the United States and say, we don't want to pay tariffs, we'll hire your people to build our product. That's good for the country, and it's particularly good now for individual investors who have paid attention to this and diversified their account, concentrated into those areas of leadership, and they are pretty easy to identify with inexpensive data and a little bit of time. We are active, dynamic managers. Market is dynamic and we respond to it. We do not forecast the market. Anybody tells you that the market's going to be at some given level in 6 months from now or a year from now, it's a guess. Nobody knows. They're making a swag, a wild guess at where things, in their opinion, should be, could be, may be. But all we do know is where they are now and where they have come from. Now you get to make a choice. How far back do you look to determine the trend of the assets that you want to own, the sectors or the industries you want to invest in? And that's all we do. We're just simply looking back and saying, here's the current trend. This one remains strong. This one is topping out. We'll see if it regains strength. If it doesn't regain pretty quickly, it will be lagging again, and it's going to come out of the portfolio. So a month ago, we had a different position for all of our portfolios. Now, we run 3 different portfolios for individual clients, partly based on the amount of capital they have, partly based on the fees they're willing to pay, and partly based on the universe and how limited the universe is of the exchange-traded funds that we work with in those portfolios. And we maintain 5 similar portfolios for 401k investors. But this is our portfolio from a month ago, and here's where we are today. These portfolios have rotated, recognizing the changing strength of sectors within the marketplace today. We are committed to owning leadership and removing laggards from the portfolio. If it's losing money, and particularly if it's performing less than cash, we do not want it in our portfolio. We don't own bonds. Age is not a factor. The market doesn't care how old you are. The market doesn't care how much money you have. The market cares about what's working. And if you pay attention to what's working, you improve your odds of getting closer to your financial goals. Well, just recently, we had a company that we contracted with to do some work for us, and a couple of young men showed up to give us a bid on what that work was going to be. They're both single, as I found out in the course of conversation, and they also said that when they found out what we did, that in the course of their day, they were either talking about their next assignment or they were talking about the stock market. And one of them said, yeah, in fact, I bought some options before we came to work today. I really like the S&P 500. And I looked at him and I said, so you just basically buy the S&P? He says, yeah, that's all I do. I said, so you've never been through a 50% drawdown? And he had this blank look on his face like, what are you talking about? 50% drawdown in my account. So, well, yeah, I mean, my goodness, the S&P being down 50% is not a big deal. It happens, and it happens more frequently than investors want to acknowledge. So I'm saying let's just assume, since you're buying hold. This is all you're going to buy because you're diversified, you own the market. Let's just assume that you have taken some time to do some observation as a single guy, and you find an attractive woman that you're really interested in, and you finally get up enough courage because you've done your research as you would for stock, and you ask her out and she says yes. So you go out on this date, and somewhere in the course of the evening, you do something really stupid. And you try to apologize, and she says, no, just take me home. No, take me home now. And so you do. You get in the car, you take her home. You get out of the car and trying to run around to open the door for her before she gets out, but she's already walking, and she's up. You chase her up to the front door, apologize again, and she looks at you and says, don't ever call me again. What are you going to do? What are you going to do? You going to call her again? Probably not. You know, if the blunder was big enough and she's that upset, you're probably say, well, that one didn't work. I'll go find another girl. Well, that's basically the way stock market should work. If you're investing in stocks and you do a lot of research and you find a stock that you really like and you're pretty convinced that this is a good buy, I'll spend my money on this one. You know, I think it's going to continue to go up and it should be a big winner. And then the company announces something and the stock price just collapses. It's not down 1 or 2%. It's down 10, 15, 30% in a matter of maybe hours, but perhaps over days. And you're saying, you know, I didn't want to, but I believe in the company. Are you going to call the girl back because she told you to get lost? Well, this is the same decision with a stock. It's down 30%. Say it didn't work. In fact, if you were paying attention, you should have gotten out of it before it was down 30%. Save some capital and then find another date. When you're looking at your portfolio, view them as short-term dates, not weddings. You're not getting married to every investment dollar that you put into your portfolio. Some of them are not going to work. That's reality of the stock market. And you don't know which ones aren't going to work. That's reality. So what are you going to do about that? Well, we're not in the interpretation business. We're not in the prediction business. We're in the interpretation business. When things don't work, we sell them. We find something that is working. You replace poor performance with better performance. Markets are going to change. They have always changed. They are not constant. Buying an investment and holding it for life denies the reality of stock price volatility. You should be worrying about it. But if you have a process and a discipline to implement that process, you should be able to sleep at night. If you're not, you really need to talk to us. So let's take a look at what you actually own in your portfolio. What's causing you the anxiety? You can give us a call. The subscription information and contact information is on the screen. Subscribe to our podcast. We have a lot more coming. Thanks for your time today.